Now we'll move on to our panel discussion. We have panelists Vineet Gumasta from Rabobank in North America and Erjun Chen from CIT Bank in the US as well. Vineet and Erjun, would you like to introduce yourselves?
Yep, I can do it first. Good morning, good afternoon to everyone. Hope everyone is keeping well during these unprecedented times. Let me introduce myself. My name is Vineet Gumasta. I have 2 decades of experience within Treasury and Markets space on first line as well as second line. I've worked in Asia Pacific region and moved to US in 2015, where I was tasked with the implementation of enhanced prudential standard for North America operations. Recently, I have changed my job within the Rabobank, and I'm heading the IBOR business strategy. Thank you. Erjun.
Thank you, Nadeem and Vineet. Hi, everyone. Good morning and good afternoon. Thank you for attending today's webinar. I hope everyone is doing fine in this unprecedented time. My name is Erjun Chen. I'm working at the Internal Audit Department of the CIT Bank in US. As an internal auditor at the bank, my responsibilities include auditing the liquidity risk management, market risk management, capital stress testing. I also cover other treasury activities such as funding and investments. Before working at CIT in US, I worked for 2 of the Big 4 accounting firms for about 10 years, performing financial statements audit in the financial industry. Before that, I was a FX trader in China. Today, I would like to use this opportunity to share my knowledge of auditing liquidity stress testing and learn from other panelists and audience. Lastly, but not least, I want to thank the organizer for organizing the event. Thank you, and back to you, Nadeem.
Thank you, Erjun. Good introduction. Just for the benefit of the rest of the audience, my name is Nadeem Shamim. I'll be hosting this panel discussion, and our focus will be on the impact of stress testing and what are the changes around it. For the benefit of the audience, my background is cash and liquidity. I've been in this space and Treasury for nearly 30 years, having held leadership roles at organizations like JP Morgan, Standard Chartered, ABN AMRO, and RBS in Asia and in Europe. So the topic really is to say, what's happening around stress testing? What is the impact of the pandemic, COVID-19? What are the changes and developments taking place in the market? And also to see, what are the secondary issues that we should be looking at? And that's where we've got input coming in from Erjun to say, how good is the stress testing that we're doing in terms of auditing that process as well? And Vineet will share his experience in terms of actually carrying out those stress tests. Let's start with the first question. What are the latest trends and developments with regards to liquidity and intraday liquidity stress testing that you're seeing in the market? Vineet, would you like to take a shot at answering that first?
Of course. I think overall, from the perspective, I think you gave a good introduction, Nadeem, by linking it to pandemic. I will reserve my views on pandemic impacts and other things for the later stage, but I will try to cover mainly on what are the latest trends which we have seen in the last couple of years. Overall, I think if you look at it, the common data set usage, which is used both by first line and second line, and even reporting teams at times, that seems to be quite a big focus in liquidity stress testing, because it is helping us do analytics at a granular level, which is feeding into assumptions. And when you have granularity, you are able to slice and dice your data into liquidity characteristics. When we started liquidity stress testing, I think post the crisis, everybody was looking at liquidity reports, which were classified on the basis of so-called balance sheet reports or regulatory reports, which were driven more by accounting professionals rather than thinking through the liquidity characteristics. That has changed quite a bit drastically as we started to look at different aspects of each individual line item and deciding how we are going to stress it. And if you have a granularity, you can make a variation between balance sheet lines to stress test appropriately based on their true behavior. Other aspect, I think I'll try to keep it a little short, so I won't drill into the regular topics which we have seen, the importance of second line and other aspects. I won't drill too much on that part. I think another aspect which we look at it is overall awareness within the organization has improved quite drastically. We are seeing quite business engagement, and they are getting engaged with a simple solution which all treasury functions have implemented by feeding stress results into FTP. Now, once you start feeding stress results into FTP, fund transfer pricing, ultimately the business becomes quite engaged into discussions, and they are more than willing to help us validate all the assumptions. And awareness across the organization, because of the liquidity buffer cost associated with liquidity stress testing, because you're creating a counterbalancing capacity. Awareness across organization, board level questions are coming, and I should give kudos to the regulators who have helped us with regulation, plus a lot of horizontal reviews, which have pushed us to this level where we are thinking and breathing liquidity. And the last point I would like to raise is, which I raised it in the last Liquidity Congress when I did the presentation on liquidity stress testing, is model rigor, which was missing in liquidity stress testing space, because most of our assumptions used to be based on what we call as qualitative or expert judgment based. Now we are putting a lot of effort towards gathering data, and even intraday is helping us, because intraday information is helping us to feed certain level of information, which we are using in even end of day stress testing to some extent. And so some sort of a model risk rigor around qualitative assumptions to validate those assumptions is very important, because that's the challenge which was missing all this while. I'll stop here and let others comment on this.
Yeah, Vineet, thank you for that. I think you raised some very interesting points. The ones that I really picked up was the granularity is key, and being able to go down to the granular level and start flexing the ability how you carry out stress tests, not just once, which is required for regulatory purposes, but more on BAU basis. It becomes almost like natural and day-to-day process of doing your stress testing on a more granular level. And I think your comment on the FTP conversation, which is becoming more and more more often, is quite key to getting the use of stress testing embedded in an organization, because that shows it's no longer a cost discussion. It could easily be a revenue generating discussion. With that in mind, what are the challenges do you think a bank faces when defining and carrying the stress tests? When looking at the stress test, what are the assumptions that need to be taken into account? You touched, Vineet, a little bit on the data itself. Can you talk a little bit more in terms of what other challenges there could be, such as potentially the liquidity pool maybe that needs to be evaluated and the flexibility around it?
Yep, of course. I think one of the challenges which I touched upon, that the improvements are taking place in the data space, but we are not there yet. A lot of work is being put into that in terms, because you need data for historical analysis. Then substantiation, how do you substantiate? So that continues to be a challenge. Of course, it is evolving, and in the last 5 years, I think the industry has moved quite a bit from so-called normative calculation to customized stress testing. Now, one of the things which I feel is very, very important in determining stress scenario, doing stress testing, is understanding your balance sheet better. And for understanding your balance sheet better, you need to engage with people, as I mentioned earlier, with really the first line staff who understand the business better, seasonality better, and you have to substantiate with the data if at all it's available. If the data is not available, how do you bring in some sort of a rigor around the data to see we make reasonable assumptions on stress testing? But overall, you need to understand the risk drivers for your balance sheet. And that particular analysis is quite a bit top-down approach to some extent, because you have to decide certain things, especially with respect to understanding the key liquidity drivers and from the risk appetite statement, it has to percolate down. And all this has been happening on paper for many, many years. But I think, Nadeem, you raised it a very good point from the perspective of revenue understanding. You can have a discussion around revenues if you understand stress testing better. And that's the challenge. Initially, I think, and this is a COVID-specific example I'll give you, we found overall, I think, every organization, when you had draws on your commitments, everybody saw businesses getting engaged in the process. They wanted to know, because everybody wanted to support their existing customers. But existing customers is fine, but new businesses and other things, definitely, it's to some extent was put on hold initially as a knee-jerk reaction. Of course, central banks stepped in, and after that, things started to normalize a bit. But the focus continues to be on the right side of the balance sheet, which is on the liability side. And all the stress effort or all the stress substantiation work has been done mostly on the liabilities in terms of behavioral modeling. I thought initially when stress testing started, the more focus was mostly on liability side. And on asset side, because of the lack of data and other aspects, people were more focusing on taking a conservative approach. I see a great opportunity in modeling your assets. And if you model your assets better, especially in the liquidity stress testing space, you can bring in some amount of liquidity out of your buffers. Again, when we go into the intraday liquidity stress testing space, that will be a challenging subject as well. That we are looking at only one-day cash flow or intraday cash flows. But overall, I see, if you're looking for a term liquidity survival period, I think that there is a lot to be done on the asset space, because not much has been done on the modeling side, on the asset side.
Yeah, so I think, Vineet, you're absolutely right, because this is what we're seeing is the risk around credit risk is going to be a bit of a challenge here. So if you've got your loans out to various underlying clients, the credit risk is increasing significantly. And that's where the Fed has come back with a recent stress test saying that the amount that needs to be allocated to potential loan loss needs to be increased significantly. Arjun, can I ask you, in terms of how do you define the scenarios, what advice do you have from the audit's point of view to a person who's running a stress testing function to keep that in mind?
Yes, thank you, Nadeem. From the internal audit perspective, when we cover the liquidity stress testing, including scenarios in US, from my experience, we are following three key regulations. They are SR 10-1, Interagency Policy Statement of Funding and Liquidity Risk Management. Another is SR 11-7, Model Risk Management. And we also have one SR letter called SR letter 13-1 for internal audit. Certainly, I know that the regulations or regulatory requirements could be different from jurisdiction to jurisdiction, but the theme could be the same. That is, internal audit, when covering liquidity stress testing, should cover all the key elements, or so-called to cover end-to-end process, not only one or a few key elements. For me, following the relevant regulations is our starting point. As Vineet mentioned earlier, it is important to have the right data, models, and assumptions. And he also mentioned the challenges of getting the right data and understanding the balance sheet. These areas are definitely our focuses when auditing the liquidity, including the scenarios. For example, for the data, when you use the data to build a model for the liquidity stress testing, internal audit wants to make sure the data is relevant for the institution. If you have your own historical data and long enough, and your risk profile has not been changed a lot, then the data should be good data. However, if you do not have your own historical data or not long enough, normally a firm has to buy industry data to build the model. In this situation, the internal audit has to perform audit procedures to ensure the industry data is relevant to the institution and reflecting the risk profile that the institution is facing. Same thing for the models. SR 11.7 states all key factors impacting models already. When auditing the models used for the stress testing, internal audit normally would follow the SR letter's requirements to cover an entire cycle of a model, to include but not limit to model development, validation, governance, model owners, model users' responsibilities, as well as internal controls, and so on and so forth. As for the scenarios and the assumptions, as what Nadeem you asked for, internal audits wanted to make sure the scenarios and assumptions used are severe enough and also relevant to the liquidity risk that the institution is facing. I think today's pandemic could be a good opportunity to do a backtesting, to test if the scenarios and assumptions are severe enough and relevant to address the liquidity risk that the institution is facing, because the pandemic is the real case already. Also, for the balance sheet, either you focus on the right-hand side or left-hand side, or focusing more on the left-hand side, as Vineet mentioned. To me, it is the risk identification in order to have a meaningful stress scenario and assumptions. When we do the audit, we will normally test if the institution has the process and controls and protocol relating to the risk identification, which certainly relevant to the scenarios and assumptions. Back to you, Nadeem.
Great. That's really useful. I think a couple of points that I really picked up which were worth considering is that, and are the scenarios and assumptions severe enough? It's all very well having your stress conditions laid out, but do they really stretch the balance sheet and the liquidity position severe enough? And also the other element that was quite interesting was that you started off talking about the external regulatory needs. Maybe you could share something on the impact also, so the part that internal audit plays around saying the scenarios that need to be defined to meet your internal policies as well. Is that something that you can talk about around as well?
Yes, I can talk about my own experience because my company is not allowed to talk about company specific. What I'm sharing is my personal knowledge and by working in this field for a long time. And definitely scenarios are key to the liquidity stress testing. So even from the SR Letter 10-6, it suggests that the institutions at least should have 3 scenarios for stress testing of liquidity. So one is the market scenario, another is the firm specific, the last one is combined. So at least these 3 scenarios that the institution should consider when do the stress testing. So certainly the institutions they are doing things differently. They will add more scenarios into it, maybe firm specific, which is very good because you want to do more scenarios and to see or view the liquidity results from different angles. So when you also design the scenarios, internal audits also want to take a look at your methodology, right? So it's not just saying I'm doing the market firm specific or combined. So normally a firm should have, to me, it's like bottom up approach or top down, and also top down approach. So making sure that you have from strategic perspective, you have bottom up view on your balance sheet and the activities of the business, and also from a detail level or from a granular level, you have a bottom up
approach. So these two approaches together and can form a very good view in terms of the risks that the institution is facing. Then you can form a meaningful scenarios. When we do the auditing the scenarios, as I mentioned before, so we'll look at the whole process from the forming of the scenarios, which is the risk identification, and if you have protocol to identify the risks using bottom up or and top down method, and also if you have the policy, if you have procedures, if the scenarios got approved by your senior management, and sometimes it should be reviewed by the board of directors. So we're looking at this evidence, making sure that you follow the protocol. You have the policy, you have the procedures, you have the protocol, you have the oversight. Also, the second line is also important and playing a key critical role in terms of scenario design and applying a right scenarios. So internal audits also not only cover the first line, but also cover the second line as well, making sure they have appropriate protocol of performing the oversight over the first line developing scenarios. So with that, and the internal audit role is to making sure that and it's appropriate the scenarios utilized in the stress testing is appropriate, reflect the institution's risk profiles, and has enough oversight in the proving process and the reporting process. And one thing I want to add, another thing is that the internal audit is looking at is the sensitivity analysis. So you have the right scenarios and you design very well, you follow it through, you input those scenarios into your models already. And we're also looking at a firm, making sure that the firm also has a sensitivity analysis done periodically on these scenarios. So making sure these scenarios from time to time still relevant, still key to the stress testing. So I mentioned relevance and relevancy a lot because that's a very important element to the liquidity stress testing when it comes to the data and scenarios.
Yeah, thank you, Arjun. You make a very valid point in terms of the sensitivity and the scenario being relevant. And with that in mind, my question would be to Vineet. Let's start with Vineet anyway. How often do you feel that in order to stay relevant and the analysis that you do is comprehensive enough, how often do you need to change the criteria of the stress test? And how frequent? What is the frequency that you're seeing coming the norm going forward as well?
Yep. Thank you, Nadeem and Arjun. I think Arjun made quite valid points with respect to sensitivity. I think overall, the way I look at it, and Arjun made one point with respect to the scenario being relevant. Now, scenario being relevant, we don't change our scenarios multiple times during the year. We have a view and we take a longer-term view, but we do change assumptions comparatively more often. We do review our scenarios quarterly, but we don't change the scenario drastically, so to say. When you do these assumptions, and that's one of the points which I wanted to raise is, when you do the scenario design or scenario narrative, you need to be generic enough to give you flexibility to play around with individual balance sheet line items. If you're going to make it too specific, of course, you will have a view that interest rates are moving up or something like that. But if you try to define what kind of impact it will have on individual balance sheet line items in the scenario design or scenario narrative itself, then you will have a problem. But if you try to keep the scenarios generic with the view, medium-term view in mind, and then you try granular on your individual balance sheet line items and try to substantiate assumptions based on historical data or your quantitative assessment, I think the need for those changes may not be so often, but because you are continuously refreshing your historical data set. And if you see changes there, you can still go and change your stress assumptions. Another aspect which we keep on looking at is because regulators pushed us to implement so-called consistent scenarios across multiple organizations sets in US. Now, when we started looking at, so when a global organization is looking from the top, they have a view of each entity in terms of how they're managing the liquidity. Now, with EPS, what has become very, very relevant from the perspective that we've started looking at transferability of liquidity. And we have started looking at where the liquidity is trapped and the stress scenarios. Now, if we have different sort of entities, if we have a, say, called retail bank in our portfolio, we have a broker dealer in our portfolio, finance company. Now, assets which are sitting in each of these entities are going to be different from what we are doing possibly in a branch. Now, when we are defining these consistent scenarios, it's going to be very, very critical that we try to give some flexibility, because if you're going to make it too rigid, it's going to be very difficult to apply those scenarios consistently to different entities which have a different business model. Now, severity of scenarios was also touched upon, Arjun. I try to connect severity of scenarios into how best you understand your balance sheets, risk drivers, liquidity risk drivers, and vulnerabilities of your balance sheet. If you understand that, then you can try and map it to your so-called LCR-based classification or liquidity product definitions. And after that, you can do your historical analysis and try to bring in sensitivity element, which Arjun touched upon. And then you have to look at materiality or weighting with your balance sheet to come out with stress parameters for each of the risk drivers. And if you are following that sort of a consistent approach of thinking through each balance sheet item through this sort of a metric structure, you will have a flexibility and you will have ability to change your so-called parameters or assumptions without changing your scenarios, because you will try to draft scenarios in such a way, and you can always add. And as a second line practitioner, I always said that we can always add multiple scenarios. We don't need to make all scenarios binding scenarios. So we used to run a lot of sensitivity scenarios as well. That used to provide input in terms of how the balance sheet is heading, which gives you a more forward-looking view in terms of, and we do understand what is the model risk. So sensitivity gives us comfort on what kind of model risk we are running. And do we need to take additional buffer, or do we need to address it structurally different? I'll stop here and I'll take any extra additional questions you have.
I think you made a very relevant point. I think one of the questions that I had was, you said that you can define the scenario fairly broadly and then have the elements in there so that you don't have to redefine the scenarios. Do you think there is a potential, or there's a trend towards having a tool or tools available that you can say, all right, I will define a very specific scenario for the different lines of business separately, and therefore I have the flexibility to go deep into a particular line of business in a more granular way, as opposed to keeping it rather broad, and then, which is almost like one size fits all, because the technology was not there, or the access to data was not readily available. Do you see that there is any change coming down the line from that?
Yes, Nadeem, thank you. I heard what Vineet said about the stress testing, and that definitely makes sense to me. I also think, Nadeem, you raised a very good point about the tools. Certainly, the tools are important for the stress testing. If you have a right tool or tools, it will give you the flexibility to do the things you want to do, especially for the development of the scenarios, assumptions, and managing the intraday liquidity. For example, for the scenarios and assumptions, the good tool will provide the flexibility of designing an ad hoc scenario or assumption. It will enable that you hold other factors impacting liquidity stress testing constant, and only to shock the scenarios or assumptions that you are interested in, then to compare the results to see the impact. If you do not have the tool, certainly you could do it by using spreadsheets, but to an institution having a complex balance sheets and business models, it will be hard to use the spreadsheets to manage the liquidity efficiently and effectively, including scenarios, assumptions, and intraday management. Therefore, the good tool will unpack and provide the flexibility needed to the first line when measuring and managing the liquidity risk. Back to you, Nadeem.
Great. Thank you for that, Arjun. So I'm conscious of our time as well. So let me ask a final question to you both. And Arjun, maybe you could start, and then Vineet, if you could add your thoughts. In terms of the current pandemic has created a lot of stress in the market. Do you see that stress testing has come into its own on the back of the pandemic, from a pure regulatory process to a more BAU process, and it's shown its value?
Yes, I think the liquidity stress testing, to me, should be a business as usual process. Reason being that is that you're doing the stress testing not for the regulators, not for the current pandemic situation. You're doing that is for the going concern of your institution to make sure that at all the time your liquidity post-stress results are sufficient enough to support your normal business. Internal audit plays a critical role to ensure the institution has the process and controls along the liquidity stress testing. It is not only cover the policies, procedures, but also the first line and second lines business as usual internal controls. Internal audits will look at the documentation and audit trails that the first line and second line have to support that the process and the controls are being carried out. In addition, it is obvious that during the current pandemic, liquidity and liquidity stress testing plays a key role to institutions. It is worth to mention that it is very important to have mechanism, systems, and tools in place to collect and report intraday liquidity so that the senior management could be able to see daily and intraday liquidity timely to make the right liquidity decisions. Yeah, liquidity stress testing is a business as usual process. Internal audit should cover the stress testing from time to time.
Thank you, Arjun. Thank you, Arjun. Vineet, similarly, I mean, in your view, do you think stress testing has become, intraday liquidity stress testing has now become BAU process as opposed to regulatory checkbox now that we've got COVID-19 and the pandemic upon us?
Yep. Thank you, Nadeem. I agree with Arjun on acceptance of liquidity stress testing as a steering tool. At least for material entities, banks have invested in system, tools, data, especially real-time data, and engagement across organization to get dynamic balance sheet, accurate dynamic balance sheet views. Buffer, negative carry, intraday double duty have become regular ALCO board topics. As the realization is very evident that efficiency will drive the business strategy.
Great. Thank you, Vineet, for that insight as well. Arjun, Vineet, thank you very much. This has been a fascinating discussion. Very much appreciate your input and from practitioners' point of view.